Let's also do the live streaming part. Just wait a minute. Perfect, great. Great. So I think let's begin. Most of the people will join gradually, and I think we have good set of 50 odd people, and some will catch up probably in next 5-7 minutes. I would like to welcome Abhishek Tiwari from PGIM India Mutual Fund, and also we have Amit also from PGIM India Mutual Funds. Amit initially told me that he would like to introduce PGIM. I told him you don't need to introduce PGIM now. Most of them know PGIM because of the strong pedigree and the strong bouquet of product and the performance that the fund house has delivered probably in last 5 years. And definitely when Abhishek will talk about later some of the funds he will introduce. But let me first introduce Abhishek, who is out here. So Abhishek Tiwari, he is the CBO, Chief Business Officer of PGIM, and he has 15 years of experience into sales and distribution, and he has worked prior to working with PGIM India Asset Management Company. He has worked with JP Morgan India, and he has also worked with companies like DSP, BlackRock, HDFC Mutual Funds. So Abhishek has strong, I would say, expertise and domain in terms of, about sales and distribution of product, designing the product, and also working with the core team. And before joining PGIM, Abhishek had also worked with Edelweiss Mutual Funds and have also worked on portfolio management services and AIFs. So on that note, I would request Abhishek, people are waiting to hear from you about the new investment product REIT. REIT is something, which is very new to India. In fact, till now, I have not invested. So I also had certain queries in terms of, what exactly is REIT, the taxation structure, how the dividends keep coming in, or whether it will get captured in the price, some of the REITs which are listed. And as a part of asset allocation, how important is it? Whether one should, buy a real estate property, or we can actually look REIT as an alternative, as a part of, when we talk about diversifying and doing the asset allocation. So all those questions are in the mind of audience. And I would request you to, please go ahead and, enlighten all of us. Thanks, Abhishek.
Wonderful. Thank you for that kind introduction, Saurabh. And thank you everyone for joining this call on a Saturday morning. While, I am from a sales background, let me try and attempt that first and give you two more reasons as to why you are taking out time today and how it will help you. Let me first of all congratulate Saurabh for taking this initiative, because, it is times like these. And the reason I'm saying times like these is that we as investors and as participants into the financial services business should realize that we are coming off a very, very different cycle. So in 2014-15, when Mr. Rajan, who took over as RBI governor, one of the changes that he had done was inflation targeting in his policy. Now, if you think of it, it was a change, but it is a regime change in the way things were being run from a central bank perspective. So the central bank is only and only now determining as to how fiscal policy, in technical terms, how the fiscal policy will be taken care of, and hence inflation targeting becomes the key. Sorry, Saurabh, I think the video had gone off.
Yeah, I wanted to spotlight for you.
Sure.
Spotlighted you.
Yeah. So what I was saying was that there has been a regime change, and the reason I'm bringing it out here is let's also realize it also coincides with the time frame in the global markets where it has been one of the lowest, or a trough kind of a situation in terms of interest rate scenario. What you should know is that in this time frame there was close to about 70% plus of bonds in the developed market world which were yielding zero or negative. And I'll try and connect the dots of whatever I'm saying right now in terms of telling you how it is important. Second is that if 70% of developed market bonds were yielding zero or negative, obviously there was clearly a reason for people to buy risk assets. In simple terms, if you're not yielding anything in your safest or the perceived safest bucket of investment, you are forced to invest into a little more riskier asset to be able to compensate for that yield. What is happening now? What is happening is that central banks across the world who had earlier coordinated and made sure that interest rates were zero or negative are the same central banks which are coming off and saying that now we need to repair that and make sure that you have a better balance sheet, and hence the rate regime has to come back. And that is why I said I will congratulate Saurabh for taking this initiative, first of all, because when you see this regime change, you need to also maybe think about your investments from a little different perspective. So what is REITs and how does REITs come into this picture? REITs, in simple terms, let me just define it. It is real estate investment trust. For a very simple understanding, if you were to think of it, REITs is essentially a mutual fund of properties. So I'm trying to make it very, very simple for everybody here. And the reason I say it's mutual fund for properties, because in mutual funds, the basic principle or premise that a portfolio starts with is that there's a common pool of asset with a similar goal that you are driving towards, and you get the benefits of economies of scale, professional management, liquidity, and so on and so forth. Similar to that, when we talk about REITs, and this is the listed parts of REITs that I'm talking about. We will also get to the other part of the REITs, which is private REITs or mortgage-backed REITs. But the listed part of the REITs is essentially like a mutual fund of properties, right? So all the benefits that you have in mutual funds are the same benefits that you will have in REITs. The only difference being that this is a mutual fund of real estate, where properties become the underlying securities for the real estate investment trust, right? I will, at this juncture, pull up the presentation so that whatever I'm saying, you can also make a little more sense of it while looking at, some of those slides. Just give me a second. Let me know when you see it.
Yeah, it's visible.
Wonderful. So on that note, when I talked about, what is a REIT, let me also quickly jump into that. How does it become important for an investor? And when you think of this, what we have put together on this slide, essentially REIT is an instrument which gives you the best of both worlds. So it is not only an instrument which gives you capital appreciation. And how does capital appreciation come into play? The underlying properties can trade at a premium because of the expectations or expected growth rates in terms of the vicinity that those properties are, or the kind of services that those properties are used in, can mean that on a traded basis, it can trade at a premium. Second is the underlying value of that property itself appreciates, right? Second is income generation. So REITs, and as the ruling goes, and this is a rule which is also applicable to the REIT market in the global parlance, 90% of whatever you earn out of a REIT structure has to be paid out as dividends. So, for example, if you are running a REIT with 10 properties underlying, whatever those 10 properties will earn, whether it is in form of capital appreciation, whether it is in the form of earning rents, all of those earnings put together at the end of the day will have to be put into a dividend paying account to the tune of 90% of whatever you have earned. So that is the compulsory reason. And I think that is a brilliant thing for an investor, because then you have a line of sight of what is going to come in as something that will accrue to me every year, right? The other thing is that the dividend yield in most cases also forms to be the larger part of the overall returns, And why is this important for you as an investor? Because when you think of it, each instrument has its own characteristics. When we talk about equities, most equities are talked about from the nature of growth. So everybody asks, how much do you think the company will grow, right? When you talk about fixed income, people will ask about what is the yield? What am I going to make in a year if I hold this fixed income instrument, right? For a REIT, It is dividend plus capital appreciation. But because dividend is a large element, when investors look at this asset class, and when I say investors, please, what I mean by investors is large institutional investors in the foreign markets. What I also mean is, mid net worth, high net worth investors, family office investors, mutual funds as institutions, insurance companies, and so on and so forth. So every investor who would be participating in this market would be starting to look at this asset as an asset which has a high degree of visibility in terms of earnings or dividend earnings. And that becomes very, very important because people like income generation assets. Let me move on. And I think a large part of this is already kind of covered by me, but let me get to the quick pointer right at the end of the slide, which is that there are two types of REITs. There are equity REITs and there are mortgage REITs. What is the difference? Equity REITs essentially own and operate properties which are of use in some format or which are, service-oriented properties. So, for example, residential properties, properties which are being used as service for warehouses, logistics, senior living, etc., would come into this sort of a bucket. Mortgage REITs is essentially you lending money directly to real estate developers, and they are not listed. They are very much can be called and akin to playing on the ability of a developer directly in terms of what is he doing in his portfolios. So it is basically funding the developer for him to be able to function better, and you will obviously be able to benefit as an investor, right? What could be the difference between the two? Equity REITs are traded. They are live daily. Hence, there's a liquidity element to it, which is a big positive for an investor. Mortgage REITs will not be that liquid. It will have a structure in place. It will always have a time lag in terms of from a point that you have invested to the point that you can take that money off. There will be a little bit of a liquidity, attached to it. So if you want to redeem money, take money before the committed period, there is a high probability that there will be a large impact cost, and so on and so forth. Moving on. Sorry, there's, I think, some disturbance in the background, but quickly moving on. I think we have covered REITs, and we have also covered what is the structure of REITs. But what is important to cover is how does REIT stand to be in a better position than buying physical properties. And I think all of us, and these are very, very basic things which all of you will understand, but I just wanted to put everything in one place for all of you to be able to appreciate it. One is if you own, so I'm sitting in Mumbai, and sitting in Mumbai, if you were to even own a 2 BHK flat, anywhere in the urban area of Mumbai, you will tend to spend anywhere between 1.5 to 2 crores for a decent sized flat, right? Not that Calcutta is any cheaper any longer, right? So when we think of that, the huge capital outlay that you have to put out in one go, and that too for owning one unit, is, I would say, as when you think of it as an investor and not a consumer of that property, is a big negative, because you can only own one unit. Hence, all your prospects of whatever you will make are totally connected to that one single unit of property, and all your money has gone into that one single property or one single unit. Buying REITs, the REIT structure itself is it's a sum total of a number of properties, and you can buy multiple REITs. So not only will you be diversified within that one REIT, but you can buy multiple REITs, and hence you are diversified even more. Second, mostly when we think of it as individual investors, we would generally think of buying residential properties and also maybe some commercial properties in terms of shops and establishments. But when you think of buying a REIT structure, the equity REIT that we talked about, you can buy residential, you can buy office spaces, you can buy retail units, you can buy hospitality REITs, you can buy warehouses, logistics, data centers. And this is a very, very important one, and hence I'm going to spend a little bit of a time on this. When you think of what I'm talking about here, it is essentially the exposure to the service part of the economy, which you and me are consuming. All of us need hospitality, hotels, hospitals. all of us are ordering on our, deliver to home apps, 10 minutes delivery, 20 minutes delivery commitments. Where is that coming from? It is not coming from a warehouse 50 kilometers outside the city. It is coming from warehouses which are in your backyard, right? So these are premium properties right in the middle of the cities, which are ensuring that these delivery apps are making your and my life easier. Can you benefit by investing into it as an investor? Yes, through a REIT structure. Data centers. Think about your own data consumption. Somebody like me has two broadband plans in the house, right? I can't think of even having a one standing broadband connection about 6 years back. Generally you would carry those cards. Now I have two standing broadband connections because you and I know that we can't live without it, right? Think about the data consumption on your phone. Think about how you utilize Netflix and other OTT platforms. And we are not yet talking about 5G. US 5G rollout is just happening. I think probably with a little bit of a time lag, even India will happen. Once that happens, the data consumption will just go through the roof. Now, while you and I are consuming this data, this is coming through a server. Where is the server put in? Right? And servers cannot just be put in and left on their own. It has to be managed, it has to be serviced. The property has to be managed, and hence people or the property manager who is managing these high quality properties are also participating into the operational risk. So this is a little technical, but think of it as like a business. If you and I are running a shop, if we give some value addition, more people will come to us. Similar to that in managing a property or a REIT, if you are servicing a need and if you are adding some kind of a distinct value and operational efficiency, your service will have a better appreciation, better acceptability, and hence better appreciation in terms of price, and hence better returns for the investor. So when you think of it, equity REITs, and I'll connect the dots, when we said capital appreciation, let's also realize that capital appreciation is coming out of this as well, right? Liquidity for a physical property, I would say, is the biggest challenge. On paper, we are all very happy. I have 2 flats, 3 flats, 2 shops, and the value according to the circle rates is so and so. Think about when you go and try to sell that. Not only is there a big lead time to be able to sell it, unless and until you are in the poshest locality of your city, and the property is managed in a top-notch manner. Liquidity will always pose a big challenge, both from a perspective of the time that it consumes to be able to liquidate. Second, the final realization of value that you will actually do, because it is more about one-to-one buyer and seller. Equity REITs, highly liquid, listed on the stock exchanges. There is implied value or intrinsic value of that asset, like an equity asset, and you can invest as well as redeem at any given point of time. In buying a physical property, unless and until you are extremely well entrenched into the locality, the kind of builder, the kind of people that will be living in that property. Let's realize all of us would want to live in a society where we know who's living in, what is the quality, and so on and so forth. Unless and until you have such a strong network that you have that research on your fingertips, it is a big risk. Whereas in REITs, the biggest advantage is having people who are professionally qualified to be doing this day in, day out. So somebody like us, PGIM, and there I would say why you should listen to us and why you should possibly, while thinking of it, listen to PGIM views on real estate. PGIM real estate is in the top 3 as far as real estate management across the world. We have a size of about $200 billion of properties as well as REITs that we manage directly. And when you think of it, there are, over 1,000 resources across the world who are essentially looking at not only feeding to us in terms of being property managers and research analysts, but also managers who evaluate properties on a day in, day out basis. Right? So those are the professionals that we are talking about here. Mutual fund professionals who invest in a portfolio of REITs, right? Complexity in terms of the transaction. Just think of the layers of different costs that are involved while buying a physical property. Whereas here, you're just punching an order, whether for buy or sell. Obviously, there's a cost, the cost that you're paying for the fund. But when you total it, this is way cheaper, because here the cost is, for somebody like PGIM in the real estate, the global real estate fund that we have, the cost is capped at 2%. Whereas if you were to go and buy a physical property, you will have multi layers of cost and so on and so forth. Saurabh, you had your hand raised. You would want to add something? Okay, perfect, great. So what I am not saying here, let me state that. What I'm not saying here is that this is not a replacement to your house or the property that you're consuming and using as a user. This is a substitute for when you look at real estate as an investment, and a very, very effective substitute for that. So please don't get me wrong. I'm not trying to say that you should not buy a house for your own consumption. I think that is the best asset that any of us want to create. All of us have aspirations to create our own house, maybe two, if not at least one. But that is not what I or anybody of us are trying to imply that this is a replacement to. But this is clearly a replacement of being able to asset allocate your investment portfolio into an asset which is also going to be potentially yielding better than a physical property. Let me move on further. And when you think of it, there are, and we already talked about it, but we just try to enumerate that on this slide. The types of equity REITs. So there is industrial properties, there are office properties, retail, which is best depicted by malls, shopping centers, factory outlets, residential, which are apartments, manufactured homes, hospitality, which is hotels, lodgings, healthcare also comes into it. Self-storage, very, very interesting concept, has been a very, very big concept in the Western world. What is self-storage? Self-storage is when the cost of, like in Mumbai, right? I said, a 700 square feet, 800 square feet carpet home cost you 1.5 to 2 crores. You may have interest of keeping things which are precious to you, but you don't have enough space in your house. You use self-storage properties. So self-storage properties start from something like a locker all the way to storing some of your precious items. So if I'm an art collector, I would want my paintings, which I'm not putting up on the walls, and if there is a list of more paintings available, I would possibly store it, and I would want it professionally stored so that it is taken care of. For uber rich people in the Western world, yachts, collections of vintage cars, wine, celeries, and so on and so forth are also a part of self-storage. Then there are diversified REITs as well, who essentially would do everything that is listed here. And then you will have specialty REITs where, timber is one of the commodities which is heavily used during the cold weather in the Western world. So storing timber is in itself a very, very big ask. And there are, very, very tightly defined set of rules as to how it can be done and things like that. So timber, units become big. Cell tower. We talked about how data and communication is becoming the front and center of what we are trying to do. Cell towers is an asset which is only growing. Data centers, we already spoke about. Moving on. Now, when you think of REIT structure, and this is obviously technical, I'll try to just make it simple so that, and we can clarify this more in the question and answers round. When you think of REITs, and I'll possibly repeat quite a few things that I said earlier. When you think of REITs as a structure, REITs essentially own, operate, or even lease some real estate properties, and hence you as an investor will be able to, benefit from all those properties that a REIT or a property manager would be putting in together under his REIT structure, right? So there is a diversification benefit as we talked about. What else is the benefit is that the whole costs involved in terms of, so for example, if you are an investor and you are owning 10 properties, there are costs involved in terms of going and collecting rents, making sure that everything is in order. There's a cost of maintaining those properties, making sure that if there is a competition which is coming in the vicinity in the neighborhood, you make sure that you add those value adds to your property, which is like maintenance plus expenditures and things like that. All of that is taken care in the REITs already. Because when you give money to a professional manager, he is bound to assess on a daily basis to buy the best available assets, which are top-notch in terms of efficiency. What I mean by efficiency is that the ability for that asset to deliver a better capital appreciation as well as a better yield, right? What we have put here is the US laws, but when you think of it, in India also the rulings are very, very similar. And the reason we have put the US laws here is that the REIT industry in India is pretty nascent right now. So if you were to think of it, in total, there are 3 REITs from a perspective of pure equity REITs that are available in India. The first one going back to, I think, close to about 4 years or so. When you think of that, is not giving you enough history to be able to understand what is happening in India. But the benefit is that, assets work in a very similar nature across the world. And hence, when you look at US as a market, the first REIT was launched in 1960. So you have a very long history of being able to make sense of what REITs do as an asset class. Moving on, in India, and we have put together the structures in India. Later on, if you want to go through these things, I'll be, and we can circulate it further. But essentially, what you need to really understand and take away from this is, first thing, that when you think of REITs on an ongoing basis, they will at all points of time be sharing 90% of whatever they have generated as an income. Income is sum total of capital appreciation plus, the cash flow or the rental yields that they have generated. So it's a sum total of everything, right? Clearly in terms of making sure that from a regulation perspective, a REIT is proper. REIT is mandated at any given point of time to be generating more than 51% of its revenue through rental, leasing, and letting out of assets. So you can be rest assured that when you are entrusting your money to REITs, there is also a very, very tight law, which is regulated by the SEBI REIT regulation in 2014. And that very, very clearly makes sure that the REITs are not taking your money and using it for some other activities, right? 80% of all the money that comes into a REIT has to be into completed and rent generating assets. So a REIT manager cannot come back to you and say, oh, no, I was expecting that it will start from next month. Sorry. So, what I was saying is that REIT manager cannot come back tomorrow and say that I was expecting that the income generating asset will start from the next month, but hey, it got delayed and hence let's wait for 6 months. He can't do that. 80% in his asset has to be completed and, income generating. So when you think of some of these rulings, and it is very, very important to have that backing from the, the regulatory body in any economy to be able to understand that whether your money is in safe hands or not. And I think that is exactly what we have tried to bring out here in this slide. So I'm not going into too many technicals here, but I hope I've been able to provide a gist here to you. Now comes the point of how is it interesting to an investor? And we started by saying that it is very, very important for you to listen to this because there has been a regime change, And I would say the regime change is more so towards higher interest rates because inflation is hovering at a higher level. Interest rates will have to be adjusted, which is also coupled by governments trying to repair their balance sheets a little more, and specifically when it comes to repairing balance sheets in the US markets, which has been the source of the highest amount of liquidity that all of us have seen, right? In Q&A, if you want a little more view on that, we can have a more detailed discussion. But just to be on this track, let me quickly come back. How does it help? And REITs, and we'll come to the exact data as to why we think REITs are a very, very good proxy to be able to play interest rate cycles. But at the same time, the other beautiful thing is that within REITs, you have different quality of REITs. And when you see here at the bottom of this slide, you will realize we have put REITs on a timeline basis. So there are shorter lease real estate investment trusts, or the kind of properties that will come into a real estate investment trust. There are medium duration properties and there are longer duration properties. How is it important for you as an investor, and why should you know this? You should know this because if I'm talking about an interest rate of proxy, or I'm talking about this to be able to hedge your inflation or interest rate risk, then you also need to know that if I'm going to buy a short duration property in a rising interest rate or inflation scenario, I will be able to capture that uptick in interest rates and inflation, because that is exactly how my incomes will go up. If I am into a scenario where I think interest rates have topped out, and from there it will start going into a down cycle, I will probably look at the longer duration properties. Obviously, I'll assess, everything else remaining constant. If you were to just think of it from a duration perspective, I will buy the longer duration properties, and hence I will be able to lock in my assets at a higher yield for a longer period of time, without being exposed to the risk of generating lower income. So the diversity in terms of the kind of assets available is also very much there. That is the second one. So if you think about self-storage properties, I talked about locker as an example. A locker can be leased for as low as 30 days, or in fact even lower. And that is the asset which gets repriced on a real-time basis. Think about managed residential apartments. They get leased for 12 months. So in 12 months, they are going to get repriced. Industrial properties, specific industrial properties can even get repriced on a 3-month and 6-month basis. Storage facilities from a logistics and warehouse perspective, clearly going to be pegged to the market rates, and so on and so forth. So if you are into these kind of properties, you will tend to benefit in a rising interest rate cycle, because not only will your cash flows improve, but also the investor set that is looking at this set of properties will like to move their money into a set like this. Coming to the point, and I think a lot of this has been covered while I have made an attempt to explain what is REITs and how is it beneficial for you as an investor. Specifically, when we think of it from an Indian investor's perspective, really believe that now as a mutual fund industry, we have at least 2 to 3 products which have been launched in the last year or so. One being the PGIM fund, which we have launched just about 2 months back. It debuted in December of 2021. How is it beneficial for an Indian investor? First is that when you think of global real estate, the entire backdrop of global real estate, it gives you an exposure into the quality or the segment of properties which are yet not evolved or available in India. We are seeing some of those trends come through. So obviously we are all, when you read newspapers, you would hear about data centers, you would hear about urban apartments, you will hear about grade A offices, and so on and so forth. These are trends and these are opportunities which have been available in the global markets for a very long period of time. And hence the markets are deeper, more stable, and hence the investment managers understand that much better. So for you as an investor, you get that benefit to be able to participate into assets and opportunities globally. And there will be different markets who would specialize for different things. Second is potential hedge to inflation. And, when you look at, and this is hard data that I'm talking about. This is not a view, this is a hard data. When you look at last 41 years, in the last 41 years in history, in 39 years out of 41 years, income from real estate investment trusts has outpaced inflation. And I'll come to the chart which will clearly show, and I'm not giving out the number yet. I'm sure you would be interested to know, okay, you're talking about outperformance, how much? And we'll come to that. access, and we talked about how owning a single property or a physical property makes it inefficient for you. So access through a real estate investment trusts is clearly one of the biggest benefits that I would say, because by just putting in a 5,000 rupee application into a mutual fund, you can practically expose yourself to all these properties that we are talking about. So what we do as a mutual fund house in India is that there are schemes or funds for an entity like PGIM, which are available in the global markets. We just put a plug and pipe your money, convert your money into dollars, pipe your money into the global markets, which also, by the way, adds to the diversification benefit, because you are ultimately buying a dollar asset. Think about it as an investor. All of what you have bought till now in terms of diversification is either equities, fixed income, international equities, right? The global funds on equities, where you get dollar benefit. You have also bought gold and some of the commodities, but you do not have an asset class which is non-equity, non-rupee. This is the only asset class which is non-equity and non-rupee. Whether this is real estate and this is dollar. So it adds a very, very high degree of diversification. We'll come to how that diversification translates in terms of numbers. Clearly, this is an opportunity which gives you two potential sources of creating alpha in your portfolio. One is through the potentially higher yield, which we talked about last 41 years, 39 years, yields or income outpacing inflation. Two, the capital appreciation, as I talked about. If there are a smart set of investors across the world who would clearly be looking at opportunities to be able to get into an income generating asset at this point of time in a rising interest rate scenario, they are all looking at this as an asset class. So if some of you like to read some of the research reports, please go to Morningstar, please go to some of the other larger rating portals who would talk to you about how real estate investment trust has become the topmost favorite for global institutional investors in the last year or so. And that will tell you, whatever we have been talking about, how does that story add up. Moving on, after all this, everybody will be interested in knowing, if we do this, Abhishek, what can potentially come out of it. And hence what we have done is, in very, very simplistic perspective, we have tried to put some sense of data, data crunching into it. And this is a chart which is drawn over 20 years, last 20 years. What we have done is that and as I said, obviously we don't have data for Indian Reits for long enough, and hence we've just put in the US data. What it is showing is that if you were to test the thesis of how REITs have performed as an asset class, or how different asset classes have performed in different inflation scenarios, you will realize that when inflation has been between 0 to 2, which is the regime that we have been in, the best performing asset class has been US equity. And all of us know how equities have worldwide performed while we were in a very, very low interest rate scenario, right? Move into 2 to 3%. That is the asset class which continues. Sorry, I think I got muted. So I was talking about 2 to 3% and 3 to 4%. So just for simplistic perspective, let me just highlight. This is the bands. The same color schemes are here on the chart. What it is essentially showing you is, as soon as the inflation starts entering into the high inflation zone of 2 to 3 onwards to 3 to 4 and 4 and above, this is how the REITs have performed. In a hyperinflation scenario, commodities, metals, they start performing the best. So when you think of apportioning your money as an investor and being conscious of what's happening at the backdrop, if you believe that the regime has changed, if you believe that positive interest rates, and I'm not talking about that we'll go into a super cycle of very, very high interest rates. What I'm talking about is that interest rates will come into a normal regime. It has remained at 0 and below for the global markets for a very, very long period of time. With all the effort that central banks are doing, we will come into a normal positive interest rate regime. And if that is the reset that we are talking about, then clearly this is an asset class which is clearly worth adding into your portfolios. We talk about the diversification benefit, right? But everything translates into numbers. The red line is the correlation number, which means that if you were an investor into Nifty, which is the top 50 stocks in the Indian markets, listed markets, and you were an investor also into Reits, the global Reits, then your average similarity in both the assets was only 11% of how the assets behave. So you're also getting the benefit of diversification. Now, let me also tell you the reason we have put in the other chart here is that let's realize anything which is listed is bound to have some repercussions of how the market behavior is in the short term. And hence, in a very, very strong equity performing market, REITs has a correlation. In a down market, also REITs will have a correlation. But when you look at the average, the mean, it is just 11% correlation, which means that if you give time to this asset class, it will exactly do what it is supposed to. As I'm sure that, you know, in other discussions like this, a lot of people would have spoken about how time is very, very important to be given to an equity asset to perform. You know, that reality will hold for all assets. And here also it is true, but it is solving for your one basic need of diversification very, very well. There are not too many asset classes which can talk about such a low correlation number. We talk about how in the last 40 years, average REIT income has outpaced inflation. When you think of it, these bar charts are essentially the average REIT income year on year. The black line is inflation. Reason we have broken it down year on year is that, you know, data can always tell very, very different stories. So it would have been very easy for me to just give you an average number and say, look, 40 years we have outperformed, or this asset class has outperformed. What I'm showing you is year on year, incomes from REITs have outperformed inflation, which means that if inflation is going up, your income from REITs will also go up and it will continue to outperform. Can you say the same for other asset classes? Highly improbable, because at the first instance, when you will think of it as an investor, and if you're holding a bond with rising interest rate inflation, you lose money because bonds are negatively correlated from a perspective, right? So, you know, the summary of this is that when you think of it as an investor, what are the three big benefits that it is bringing you? And we obviously highlighted a lot of benefits. But the first big benefit that it is giving you is that this is an asset class which can potentially always give you a real positive return, net of inflation. Two, it is giving you a very, very pronounced diversification benefit. Three, because it is equity REITs, it can give you the potential of also being surprised in terms of the capital appreciation opportunities that will come in. Now, while I have made that point, let me give you another data point, which was actually a shocker to me when we started working on this asset class. And that data point is that if you were to pick up the data for the same 40 years or even extend it to, let's say, 50 years. So if we take data from 1972 for the US stock market and REITs have outperformed US stocks by 200 basis points, which means 2% compounded for a duration of 50 years. It was a shocker to me. Now break this data down. If I was to break it to the first 45 years, which is 1972 to 2016, and I'm doing that for a reason, is because 2015-16 is the time from which interest rates have been zero and sub-zero, right? If you were to look at that 45-year data, the REITs have outperformed much better, but in this 5 years, stocks have outperformed REITs. So in this 5 years, stocks have generated 17.5% compounded. This is S&P 500 data. And REITs have generated about 8%, 8.1% to be precise, in this last 5 years. Now, if you make sense of it, and if you believe that, with all the data points that we have provided, if you think that there'll be a positive correlation to rising interest rates and inflation, then REITs will come back into a position of being able to give, any other asset class a little bit of a run for their money. By all of this, I'm not trying to say that you should dramatically go overweight on REITs. And I'll tell you why I'm not saying so as well. We are ultimately investors from India. Domestic economy gives us a very, very big differentiated benefit of having a very, very high growth rate. But at all points of time, all the 100 rupees cannot go into a single asset. And hence, this is an asset which solves for your need where you don't want to take a humongous amount of risk, but also are not happy with the lower returns that a basic fixed income instrument is generating for you today. So when you think of that gap, this is clearly an asset which can help you. Otherwise, we as asset managers, as mutual fund managers, have no doubt in our mind that if your money is slated for a very, very long duration of time, equities continues to be the best asset class possible. This data we have already spoken about, so I'll not repeat it. I will just kind of, before summarizing and closing, before opening up for Q&A, again say that when you think of it, the entire global market is extremely broad and deep in terms of the quality of properties and asset classes that are available. You look at, America, Europe, Asia Pacific, the kind of properties which are available, with the benefit of our team and the incisive research that they do, we have even classified properties in terms of what are the kind of properties where you will benefit in a cycle like this. And this is an ongoing, so this is just a representation of what our research teams do in terms of making sure that your money is managed actively. I'll not go to the scheme in specific, but I will come to this slide, which is very, very interesting. When you think of this slide, what we have tried to do is on a calendar year-wise basis for the last, let's say, 5-6 years, if you were to think of different opportunities within real estate as a segment, how have that done? And which gives you the importance of active management. If you were, let's say, for example, in a year like 2020, if you were into data centers and self-storage properties and were not there in shopping centers and regional malls, the difference in returns would have been over 40%. Now I'm sounding very simplistic. It is not as simple as that, but think about it. There are underlying themes and reasons which all of us know. So all of us know that shopping malls are not making money, right? How do you play that into your portfolio? It can only happen once you have given it to a mandate holder who will manage it actively. Else, if it's an index who's managing it, they will only, own what the market is owning. And hence an index will be an average of whatever the entire set does. Whereas an active manager, if it's a good one, then, a higher probability of him being here than here. So with that, let me quickly close this, close the prepared remarks from my side and hand it over to Saurabh to maybe make some comments and open up for Q&A.
Sure. Thanks, Abhishek, for the really very insightful, information, because most of the audience out here, they have not invested into REITs and they wanted to invest. So, yeah, can you just stop the screen sharing so that, it will be better for the people? Yeah, perfect. So, to see you and then, ask questions. So few questions have come in the chat box. I'll just take some questions have directly come to me and then, I'll take it up. So first, in India, you have some listed REITs like Embassy Park is there and you have InvITs are there. So what do you mean to say if we are investing out there? So whatever rental incomes will come, they will distribute to us as a part of dividend every year or every quarterly, whatever it is.
That's correct. 90% of whatever they earn has to be distributed as dividends.
Okay. And roughly 6-7%, what they indicate is what we can expect out of it, probably on a yearly basis. And how do we gain as a part of capital appreciation? Like, let's suppose if there is a IT Park Embassy or if it's InvIT. So how do they, calculate the, increase in the equity element and they share it with us?
So how does that get calculated, Saurabh, is in simple terms, is that if you're owning an asset which is appreciating in basic value, while, think about it, how an equity valuation is done. If I am investing into a company, first and foremost, I value its plant and machinery. So this is like valuing what your basic net asset value is. So when you think of the live listed prices for these REITs, that will incorporate for the capital gain.
Okay, so the price over the cycle, what it will increase, like 100 become 105, 10. So that is a part of the capital appreciation that has happened.
That's
and
right.
Dividend will just keep coming to us as per the regular interval what they have suggested.
That's correct, Saurabh. Let me also clarify here, since you have asked this question, that when you invest into a mutual fund, there will not be a dividend. It will all be into the net asset value.
Yes.
Understand it from the structure perspective, it is very difficult for us to be, generate a straight line dividend as a mutual fund, because we are getting money at different intervals of time. It is not a closed-ended fund. It is open, so we are getting money on a daily basis, and hence to justify it and make sure that a dividend is paid, exactly like it would have been paid if you were holding one single REIT, is next to impossible. Correct. We have just made it simple. It's an NAV concept. Everything ties into the NAV.
Sure. There's one question which has come in about the global fund, which has been recently launched, like almost 2-3 months back. The returns is showing slight negative in shorter term. So just people wanted to have the understanding that if we are earning a fixed rental income, how come sometimes it may be negative for a shorter term, and later on it will compensate? How exactly it is?
Yes. So as I said, anything which is listed is bound to move in terms of the traded prices, right? When you think of how this will translate into medium-term and long-term returns, what I can tell you safely is that when you think of global markets today, for a portfolio like us, we are having an intrinsic rental yield of about 4.5% in dollar terms, right? If you were to think of long-term depreciation benefits, on an average, if you think of very long term, the depreciation benefits for currency has been 5%, but I would say let's not take a 5% number, let's take a 2 to 3% number. You add that to this 4.5%, again, it is not like a single straight line. It comes over a cycle. So you add that to it, plus the benefit of capital appreciation. So I'm not going to put a number to the capital appreciation. What history suggests is that for 50 years, global REITs at an index level have generated a return which is 12.5% compounded.
Okay, quite strong.
Right?
Yeah. And what is the entry and the exit load in this global fund?
So exit load is just for 90 days, 0.5%. There's no entry load at all.
Okay, so Mr. Rao, as he said, after 90 days, there is exit load of 0.5%.
Before 90 days.
Before 90 days, yeah. So there's one question from Priya. She is asking, can we invest in plot compared to REITs? So as Abhishek has shared that, Priya, if you will invest, you will be investing in only one plot, one property. So the entire risk lies on, whether the price of the property goes up. Yeah, it may double, it may triple if highway comes in. But again, the risk attached is very, very high. And let's suppose when you want to sell it, there are certain litigation. Sometimes, there is also a risk of poaching also, and some kind of all those things arises. Sometimes one plot, some people sell it to twice. So if you are very confident, that is a separate issue probably. But let's say if you want to invest for a investment perspective, and if you want to diversify, then probably REITs emerges as an alternative asset class. Okay, so what is the minimum amount that can be invested? I think it's 5,000.
5,000.
Yeah, 5,000 is what is to be invested. You are saying that the returns are 6 to 7% in the form of a dividend. Mr. Prantik is asking plus capital gains on the capital gain. Is his understanding correct? Mr. Chaudhary is asking. Yeah.
Mr. Chaudhary, it will depend on the security to security. So if you take the average today for the 3 listed REITs in India, and let me also tell you as to why we still were suggesting about looking at international diversification, because all the 3 listed REITs in India are only giving you a diversification into the office space in India. But having said that, on your question to be specific, the average yields are in the range of about 6 to 7, and hence it is fair to hold on to that as an expectation in terms of yield. Add to that the potential capital appreciation. Yes, that is how the returns will translate.
Sanjay is asking, does investment goes into India or US properties? So as far as PGIM global REITs is considered, it goes into across the globe. So wherever they will find opportunity, they will tap it. But most of them are in US, Europe, and in the other regions market as of now. the portfolio holding.
So Abhishek, I would request you to, if you can just share 2 minutes on the creation of the portfolio across the global footprint.
Sure. So I think I can see a couple of questions which have already come into the chat box, which is talking about, which is a better opportunity. And I would say that think about it from a perspective that any investment that we evaluate for our portfolio allocations, we would first want to understand that whether those investments can be sustainable enough for a longer period of time. The point that I earlier made, the history for REITs in the global markets is very, very long. In India, it is just started, right? And hence I said, when you invest into it, you do get some high quality assets because, whether you think of, any of the three REITs that are listed today, all the three REITs are extremely good in terms of the quality of assets that they're owning, office spaces that they're owning, but it is only office spaces. There's no residential REIT, there's no industrial REIT, there's no warehousing, there's no data center REIT, and so on and so forth. So first benefit that I would say is of the diversity or the diversification benefit that you can get by participating to a global REIT. Second, I said is it's always better to spread your bets. So I'm not saying that don't invest into India REITs. If you are an investor into India REITs, you will do better by diversifying further by adding global REITs into your portfolio on the premise of the quality of assets. Second, you are adding a dollar asset. So, that benefits of that is immense. As I said, a 4.5% dollar asset today in a regime where your interest rates are at 2 and below is a brilliant asset to have. And let's not hold on to the 4.5% number, because tomorrow if this yield goes higher, the asset will also reprice itself.
Perfect. Mr. Narendra has one question. So essentially the properties are owned by the REITs. They are not rented by the REITs, correct?
They are owned as well as leased. It is
owned as well as leased. Okay, perfect. So they either own and they either lease it, depending upon the kind of opportunities they are getting. Right. So what is the taxable? In India, it is taxable as per the normal debt funds structure. It is there.
Correct.
So after 3 years, you will get indexation benefit, Anilji, and before 3 years, if you sell, it will be straight away, taxed as per the normal, income tax. So if you invest through mutual fund route, you don't get a dividend. Basically, the NAV appreciation that happens, which happens normally when you invest in debt funds, is like that. But like what he's asking, if we invest into in India grade and maybe Embassy Park and all, so there, whatever dividends they distribute, is it taxable?
In terms of in terms of their investment into the India investment.
India REITs. No, I'm talking about the Indian REITs. Let's suppose if we are investing into InvITs or maybe India grade, so whatever dividends they declare, so that will be taxable.
No, the dividends are tax free as of now, but your capital in REITs, but your capital gain is taxable. Exactly. Perfect. Like the fixed income.
Yeah. Okay, so Anil, I think this was a very important point, because for equities, whatever dividends we get now, it is taxable. So for REITs, whatever dividends that you will earn out of from the property, it is tax free. So again, it makes a good sense. Let's suppose if we get around 6-7% kind of a dividend yield, so a tax free income would certainly make a lot of sense, to many of us. What are the key risks involved in this asset class? Also, post 2019-20, how has the REITs performed with change in real estate dynamics like decrease in office rental? Again, a good question. Yeah.
So risk involved is that it is a listed asset at the end of the day. And hence, in an extreme volatile environment, this will also be volatile. So you will have to typically have patience with this asset class as well. If you don't have patience, then you can come out as a very disgruntled investor, because you would have booked losses. Second risk is that if you buy the wrong asset, if you end up being into a single REIT, which either from a sector perspective or from the underlying asset perspective is not the best and the most efficient. And are there examples? Yes, there are examples. I already showed you the calendar year chart of different asset classes within the REITs. So if there was people who were wanting to do it themselves and they get caught into a regional mall-based REIT, they would have not made money. So there is a very, very high amount of risk attached to security selection as well.
Like it also happened in India, Abhishek, like people who invest in the road assets. So again, because the entire COVID happened and no toll collection was being done. So for one particular year, the dividend was not being declared because it was very low dividend. So those kind of risk will be there. Certain amount. It's simply like even if you are owning your own property. Let's suppose during COVID, if the tenant goes off, they goes off and everybody's working from home. So it's like that. So maybe until you find a new tenant, it is now taking 6 months, 7 months time. So it remains vacant. Similar, that kind of risk is also attached to. But here the advantage is maybe you're owning a whole sum of properties. You're not owning one property and maybe 5, 10, 20 properties. It's just like you are diversifying it. So that is the added advantage. So Mehul has one question: with rise in metaverse, virtual estate is also gaining fame. So can we see the future of REITs? I would add one point, and then I'll like Abhishek to add on to it. Like Mehul, Abhishek said, because of this metaverse and all, you would need a lot of data centers. Because again, for all these high-tech stuffs, you need to have that data servers and all those, I would say, the places where I would say the technology and the other stuffs will play around. So I think probably, as you said, some or the other sectors will qualify. Like Abhishek said, maybe malls will not qualify. Maybe people are taking orders. You're making orders like from apps and all. But again, on the other side, you will earn higher rental income from data centers and maybe certain other kind of I would say the management of these high quality data come into place. Yeah, Abhishek, your view into that.
So frankly, I would not have I will not be the best person to be able to comment on what will metaverse do. None of us are qualified. It's not really still a science in either India or the global markets. It is something which has come as a fad for the time, I would say. Safe to comment that. Second is, if you think of any investment asset class or REITs, or look at yourself, if we were to believe 5 years back when everybody started talking about automation, and all of us would have started believing that the workforce will become redundant, then all of us should have gone out of our jobs and started something which will not be redundant. We didn't do that. We tried to innovate. We tried to adapt. When you think about any other asset class also, that's exactly capturing the ability to adapt. So think about restaurants today. In the last 2 years, and I was speaking to, in Mumbai, there is a very popular chaatwala. And I was speaking to him in the last 2 years, 9 months, his shop was closed. But he made sure that he was on Swiggy and made sure that his business was running. Think about restaurants. They have made sure that they are able to deliver. Think about liquor shops, liquor business. They made sure that they were able to lobby and ensure that home delivery was allowed. And there are businesses like Living Liquids in Bombay, and I'm not sure whether it's in East or not, but setups like Living Liquids in Mumbai, which are flourishing on home delivery of liquor. So all of this adapts, all of this evolves. I have no doubt in my mind that anything which is supporting innovation, and REITs are supporting innovation, data centers, warehousing. So anything which is supporting innovation will continue to be relevant. And hence, all the more important why you should be into a product which can actively invest in the best asset or the best portions of that assets possible.
One question has come from Soren, REITs, just a second, I'll read. 1 minute. REITs have to pay 90% of their taxable income back to investors, which significantly reduce their ability to invest back. So is it not a disadvantage? He's asking.
So not really, because, so let's break it into two parts. One is that the first and the foremost, the reason why 90% of their income to be distributed in form of dividend is important, because that is the kind of investors that are coming into this asset class. So you have to make sure that that gets taken care of. As far as reinvestment possibilities are concerned, a REIT can borrow money from the market in terms of a follow-on public offer, as well as in terms of raising money as fixed income or debt, as we call it. So if, let's say, any of the REITs, let's say, for example, Mindspace, which is a REIT in India, has to expand its asset base, it can borrow money from the market and expand its asset base, and then retire its debt and, normalize its balance sheet. So I would not say this reduces the ability at all. In fact, it ensures that the classification of this asset class from an investor's mind becomes very, very clear. What are you buying it for? It is also very important from that aspect.
Perfect. Any questions you can unmute and ask? We'll just take 5 minutes of more for Abhishek from Abhishek. And
hi Abhishek, Shreyas this side.
Yeah, please go ahead. Hi.
Just one thing, as you said, the investment is majorly in the overseas assets.
Correct.
So let's say the currency is receivable in dollar or euro, we expect a certain amount of return. So you can hedge the foreign currency exposure and get 4 to 5% return in that also. Is that a part of the expected return? How does it go about it?
So what you're saying, Shreyas, is right, but we don't do any kind of hedging in the portfolio. The whole reason why I talked about the benefit of depreciation of the currency versus the global assets is that when you think of, so our fund is denominated in dollar. So we are only converting your money into dollar. When you look at a very, very, long-term time frame of the last 15, 20, 25 years, and if you were to break it down into every 3 year or 5 year, you will realize that on an average, Indian rupee has depreciated by 3.4 to 3.5%. If you go back a little more in history, that number would be, let's say, 5.5%. Now, why does this happen? For everybody's benefit, and I'm sure you already know it, but for everybody's benefit, why does this happen? Because when you think of inflation for each of our economies, inflation in India is always going to be higher. What is inflation? Inflation just robs away your purchasing power. So if your purchasing power is reducing faster than any of these developed markets, then that depreciation of currency will keep on affecting. There will be bouts in the interim where your currency may stage a comeback. Like, for example, we have seen in the last few days, if any of you follow currency very, very closely. But when you plot a chart, you will realize that the depreciation is for real. So unless and until the entire economic framework changes, our dependability on imports goes out, and so on and so forth, and inflation comes down to rock bottom, I don't think this reality may change. In short terms, you will have volatility stress, but we don't hedge. We will not hedge. That is not what we do as investment managers. What we do is buy high quality assets, which are generating better income, which have a potential of very, very high capital appreciation, and make sure that we pass on that benefit to you as an investor. In that same framework, because we are investing into a dollar asset, you get the benefit of diversification, currency depreciation as well.
Perfect. So I'll tell you, I'll just to update you, Shreyans is into a treasury management, working with a large bank. So that's why he asked that question.
Wonderful.
Yeah. Anybody else? Any questions? Yes. Anybody would like to unmute and ask anything? Yes. Anything? Probably. I think we have tried to cover almost all the questions. Great, Abhishek. Thanks, Amit. For helping me in terms of reaching out to Abhishek and coordinating the session for us. So this is a session series which we have started, Abhishek, just to update you. Every month we are trying to do some session on some different new topics, innovative things. Like last month we did a session on the IPO fund. With the new theme, investing into IPO, but they don't know on what factors to select an IPO. What are the key things? So this time we are having on Reits and any suggestions, friends, you can just put it in the chat box. Maybe next month, what kind of sessions, or we want sessions on which asset class probably you wanted to understand. So we'll have experts like Abhishek, and also we can invite some fund managers also to clear your doubts. Okay, Bitcoin is something which has come in. So I'll have to reach out to Amit, if we have some expert within the house, so we can have it. Great. Any more asset class apart from Bitcoin, or anything also within the equity space, maybe, which you are looking forward? Great. So you can also WhatsApp me. You can also put it in the chat box. So again, thanks to Abhishek, thanks to Amit for, making this happen and explaining us Reits and putting things in a very, very simple manner and in a very, very slower manner rather. Sometimes, people go very fast and we don't tend to catch up. So really like the flow and the way you explained it. And I think, it has motivated me at least, to explore and invest. And simultaneously, I'll also recommend to all of my clients, to also explore and diversify certain part of their investments into REITs. Thank you. Thanks a lot.
Wonderful, Saurabh. And thanks is to you and everybody who could take out time for this session. I think I feel privileged to be able to share something which is critical to the journey to wealth creation. Protection becomes the first part. So I think it is important to get into asset classes which can protect and help you keep on generating wealth. Thank you. Thanks again.
Thank you, Saurabh. Thank you, Saurabh, for inviting us. And any questions which is left unanswered or you want us to get back to us, just please share those on mail and I'll reach out to Abhishek and we'll get those answers solved ASAP.
Perfect. We'll do that. Thank you.
Okay.
Thanks a lot. And thank
Thank
you
you
all
so
for your feedback in the chat box. Thank you all. And
thank you,
look
Abhishek,
forward to come up with some more interesting session next month. Thank you.
Can I have one question just last moment?
Yeah, sure, Nitin. Go ahead.
Please.
My name is Sharan Mudha. I wanted to understand, do you see any feasibility of startup being an asset class? Startup
is
being an asset class.
Startup is actually already an asset class.
Yeah.
And
Okay.
If you think of it, it is not in the public market space as it is not listed, but it is very much available in the private market space. And private market when you think of it from what private equity funds are doing, mid-market funds are doing, venture capital funds are doing, they're exactly doing what you are asking.
I was talking from the point of view of a mutual fund perspective.
So from a mutual fund perspective today, the challenge is that, we are limited to be buying a listed and a liquid asset class. Unfortunately, most of these are not liquid. There is obviously alternate investment funds, which are also somewhere an extension of what we do as asset managers. It is not mutual fund, but alternative investment funds is where we can and we are doing some of these things. At PGIM, we have not yet started this, this wing of investments. We do have licenses. We will be approaching it soon, but it's already available in the market to you.
Okay.
But in the mutual fund space, till the point the regulations do not show us a green light.
So you can actually approach them and maybe brainstorm something on this. That would be really great.
Correct. Sure. Thank you for the feedback.
Thank you.
Thank you.
Thank you. Thanks a lot.
Thank you. Bye-bye. Bye, Saurabh.
Yeah. Thank you. Bye. Bye, everyone. Thank you all.
Bye.